Hey there, everybody. Welcome to Chart This. Indeed, we are back to our normal name on April 2nd and for the foreseeable future. Chart This with Dave Keller. Welcome to the show. Happy Wednesday, April 2nd. Sorry, my mind is a little flustered trying to get my head around the tariff news that we just learned. We're starting a couple minutes late because I was trying to just digest kind of a flurry. It's like cramming for a test, trying to just digest as much as I could based on instant reaction to what we heard if you're watching the Trump press conference, and just trying to think about the potential implications. And if you're struggling to figure out what those ramifications are, you're not alone. I think that's where everyone is in. And I had an interview for the Market Misbehavior podcast a couple hours ago, which I'll tell you about in a few moments. And we're going there, and we're talking about tariffs, and it was sort of like I don't know, like this is very new. This is a dramatic change in policy and all of that, and so for now the market's selling off in the after hours. S&P was down about 2% when I checked before we kicked off here. We'll look at what happened today. We'll talk about what could happen tomorrow. We'll talk about the potential impacts. We've been talking going into tariff day or tariff week or delivery day. I forget what we're calling this. I'm calling it tariff week. I don't see how that doesn't weigh on the markets in the short term. I don't see a scenario where, at least for a while, it makes things more expensive for American consumers. That seems pretty logical. I mean, it's hard to disagree with that logic. The long-term implications, we could have an extended intellectual debate about what that might do, because there's a lot of assumptions you have to make. You have to kind of model out what a number of different things would do, what companies will do, what other countries will do, what the dollar and interest rates will do, what inflation will do, what consumers will do, and how to model their behavior. We have to make a bunch of assumptions to try to figure out the impact, but at least in the short term, I don't think that brings a dramatic end to the great bear market of 2025. With that in mind, let's get to the market recap and see how things actually played out today. So, going into the close, again, sort of a wait and see mode for the markets. Again, the tariff news came after the close. I think for good reason, because there's certainly some market moving potential there. I would not be surprised if we see weakness tomorrow. But for today, the S&P up about 0.2%. Going into the close, the S&P finishing just below 5671. So that's up 0.2%. We actually did trade down after opening lower. We traded above yesterday's close, which was around 5632. Look at how we traded down to that a number of times. Now on stock charts, kind of the default chart on the dashboard is this 2-day, what we call a tick chart, just looking at tick data as it emerges. And you have yesterday's close identified with a blue horizontal line. And that's just a helpful way, I think, of noticing or recognizing what's happening today versus yesterday's close, which is an anchor level. It's an anchor point that a lot of traders always focus in on, right? Where are we at relative to yesterday's close? Is it an up or down day? And a lot of times you will see, orders gravitate around those levels. A lot of times you will see people take action or change their perspective as we approach those levels. And that's why, having that level in mind. And if you don't use stock charts, if you use another platform, most platforms give you the ability to have a line representing yesterday's close. Big fan of that, because I think that allows you to understand why the market kind of pivots and it doesn't make sense, maybe why it does at that particular level. There's your answer, I would say. Not a coincidence in my opinion. The NASDAQ composite up about 0.9%. Mid caps and small caps, though, where the real action was. The S&P 600 small cap index up 1.5%. The mid cap index up 1.6%. The VIX drifting lower about a quarter VIX point, down around 2150. So still remaining in what we call a high volatility environment, but for now, drifting down a little bit. Again, this all can change tomorrow. My job is to I see it as to report on what happened today, to think about the ramifications of what we learned today and what that might mean for future days. We'll do our best as we get to the charts to talk about some potential future paths. But again, I'm expecting some weakness through the remainder of this week, I would say. Interest rates generally moving higher today. You can see the 10-year yield around 4.2%. Long bond yield around 4.5, 4.55 actually. A 5-year point around 3.95. Steepening of sorts of the yield curve here. We looked at, I think I grabbed that chart for today, looking at the shape of the yield curve, comparing a couple points. We'll look at that here in a few moments. The TLT really didn't change much from yesterday. The dollar as well. The dollar really hasn't fluctuated a ton, to be honest with you. The UUP is relatively stable here. And that's certainly, I think when you think about charts to follow after the announcement, right? Going into the announcement, it's a lot of like wait and see, let's see what happens, hold our breath and our nose and just wait to see what we hear. Afterwards, besides the obvious questions of looking at the S&P and the NASDAQ, looking at the dollar, looking at the TLT, or looking at interest rates, I mean, that's where you're going to see quite a bit of movement, because the dollar index is basically a weighted index comparing the dollar cross rate. So it's dollar yen, dollar euro, dollar Swiss franc, all these different cross rates, because there's no actual dollar index, right? It's just it's an average of all these other cross rates, because everything is in dollar terms for now, right? That's kind of the general convention in the currency space. You sort of relate everything back to the dollar. That's called the spot rate. These crosses, we'll see what happens afterwards, but I think that's where you could see certainly quite a bit of movement. Now that we have a sense of what this is going to be, we'll start to hear reaction from around the world, I'm sure, in the next 24 hours, and that's when we can see things move quite a bit. For now, that's where things are at. All right, looking at the commodity space, generally positive today. The DBC was up about 0.2%. Gold and silver continuing to push higher. I saw a comment about someone watching the Miss Schneider interview. We put that out earlier today. That was our latest episode of the Market Misbehavior podcast. Miss is awesome. I mean, just really, really fun to talk to her. She had some really cool long-term charts and monthly charts we looked at together, looking at things like retail, transports, small caps. I would encourage you to check that one out because we talked particularly about gold and silver. I asked her about gold and she answered about silver, and that's pretty telling. When I ask a guest about a particular thing and they say, well, that's interesting, but it's really cool, and they point you to something else, that's often where some really interesting ideas are emerge. So we talked about silver prices. We did talk briefly about gold, to be honest, but talked about silver, talked about the silver to gold ratio, which is one that I don't look probably as often as I should. So check out that interview. That was actually pretty interesting there. Crude oil prices continuing to push higher. And while the energy sector was not one of the best, actually one of the worst performing sectors today, crude oil prices, continue to kind of roll higher a little bit. Bitcoin did spike higher earlier, but now post announcement, we're seeing it rotate lower in a pretty aggressive fashion. Bitcoin was up to around 88,500 just recently, and as we're recording this, we're down, almost 4,000 points on the Bitcoin. We're down to 84,700 ish, down about 0.5%. When we were up quite a bit earlier. Ether down as well. Most of the top 10 coins in the red today. All right, looking at the sector summary, the 11 S&P sectors, you can see only one of them finished in the red today. On the top side, you have consumer discretionary, the XLY up 1.9%. Industrials, number 2. Financials and materials basically tied for third place. All those sectors had a pretty decent update. It's kind of a mix of the XLY, which is really top heavy, with Amazon, Home Depot, Tesla as the 3 biggest weights. And industrials number 2. Industrials have not been on the top of the leaderboard very often, I would say, right? That's actually been fairly rare. Financials actually have been up there, materials as well. So industrials and materials kind of lagging a little bit relative to some of the other value sectors, and certainly defensive sectors having a decent day today. On the downside, consumer staples were weaker. The XLP was down about 0.3%. So that tells you the offense to defense ratio that we like to look at, very much favoring offense here so far this week. I would not be surprised if that changes starting tomorrow. Tomorrow's show is going to be a can't miss kind of discussion. We'll try to see what happens in tomorrow's sort of reaction day and make sense of things. Energy essentially up slightly from yesterday, the XLE, and then communication services up about 0.3%. Over here, in terms of breadth, the breadth was actually quite positive today, right? So again, going into the announcement after the close, the S&P breadth pretty positive, 78% up, 22% down. The NASDAQ composite still positive, but not as good, up 66%, down 31%. But look at the breadth in mid caps and small caps. That's where you're seeing quite an aggressive move here, right? Mid caps, 88% of the S&P 400 mid cap index up, 85% of the small cap index up. So you're certainly seeing sort of this resurgence going into today's close. Again, that gives us a starting point with which we assess the reaction afterward. There's our baseline measure of where the market is at. Starting tomorrow, it's all going to be relative to April 2nd. We'll start doing some return analysis into the tariff announcement and then post tariff announcement, barring some other big announcement that I'm sure will come when we're least expecting it. All right, looking at the Magnificent Seven and Friends, the leading growth names, Tesla, by far the top performer, up 5.3%. I'd always caution you with a name like Tesla, it's kind of like looking at the daily percent returns of cryptocurrencies. It'll either be really high or really low, right? Because it's a fairly volatile data series to look at. So don't draw too much of a conclusion on the single day's return. Think about what that means relative to the longer term trend that we've been analyzing. So, think about with any of these Magnificent Seven names, it's about the 200-day moving average and where things start to approach. Can they regain them? And for Tesla, still below the 200-day. We'll look at that chart. I think I grabbed that chart. It was a flurry of chart grabbing earlier as I was preparing for the show. Broadcom and Amazon both up about 2%. I would not be surprised if Amazon was down in a pretty decent amount in the after hours. Might not be end of the world, but certainly they're one that is going to have an impact. I don't know how anyone would not have an impact by what was just announced here. Alphabet and Microsoft flat for the day today. NVIDIA, and I don't know why I have double NVIDIAs in here. I got to remove that. I tried to do that yesterday, and I forgot. All right, we'll do it tonight. So NVIDIA up about 0.25%, about the same for Apple. I mean, the challenge, obviously, all of these companies that we're talking about, and the interview I had today, by the way, that's not released yet. We're actually editing that up, but I interviewed Michael Green, and if you don't know Mike Green, he's at Simplify Asset Management. He's had a pretty fantastic career in the financial industry, made a name for himself in a lot of ways by really talking about the dangers of passive investing. Not necessarily the dangers, but just the challenges to the market structure, how different the market structure is because of so many assets that are driven by passive flows and things like target funds, where it's not an active investment decision. It's more just outsourcing that to some sort of model or some sort of advisor. And I had a really interesting conversation with him about the concentration in the benchmarks, the top-heavy nature, what these stocks are really representing. So as soon as that interview is edited, probably end up being tomorrow morning, but don't miss that one. That'll be the latest episode in our Market Misbehavior podcast. But as I'm looking at these names, I'm immediately thinking of some of Mike's comments from a couple hours ago. All right, that's it for the market recap and how things were at. And again, this is one of those kind of interesting days where this was the appetizer. The main course kind of came after the close. And I think dessert tomorrow, whatever we're going to call it, tomorrow is going to be an interesting day for sure. And so all of these, again, are through today's close. We'll do the best we can to sort of reflect on some of the after hours dynamics here. But I would say, most likely things open lower tomorrow. Looking at the heat map today, not a bad day. And again, you can see pretty much a broad advance. A lot of things are sort of flat, though, right? Look at Alphabet, Meta, Microsoft, Apple, NVIDIA, all within 0.25% of Tuesday's close here. So Wednesday was not a big directional move day. So focus on some of the things that did move. Broadcom up 2+%, Oracle up almost 3%, Amazon, Tesla both up as well. Again, I'm quite certain those gave back a lot of those gains in the aftermarket, though. All three of the top names in consumer discretionary, even Home Depot in the green today. So certainly some things to think about. I think, thinking about this market and again, just what does the tariff decision mean for like a name like Starbucks? Well, again, the best I can do is tell you from a technical perspective. And I think for so many of these stocks, what's really helpful right now is they're right at that key barometer, the 200-day moving average, right? And I think between now and the end of the week, does a stock like Starbucks hold its 200-day moving average? And if so, like, things aren't that bad. But if things like this cannot hold their 200-day, and to be fair, Starbucks is in the minority actually remaining above its 200-day as of today's close. Most S&P members are below. But I think watching to see if these names are able to hold that is pretty meaningful. From a technical perspective, to digress for a moment, Starbucks is kind of trapped in no man's land between $100 a share. That's a big round number. And you may not be surprised to learn that $100 a share often is where you find support, resistance. It's a kind of a classic pivot point because, and I think it's a psychological thing. You see it switching and adding a digit, and that's when you really start to question whether this kind of name is worth that much, or when we're above 100 and we trade below it, that often means something. So we broke below $100 a share a couple of weeks ago in early March. Now that 100 level appearing to be a bit of a ceiling here over the last couple of weeks. So we've got the 200-day around 94, $100 a share just above today's high. Like, which way do we break out of that little range? I think that could be important to watch. So with a lot of these names, I think from a tactical perspective, you watch where we're at relative to something like the 200-day moving average. See if that gives you a little insight in terms of whether there's reasons to be optimistic or whether you want to start to get defensive. Now at the S&P, you've got a pretty clear line in the sand at 5,500. That was the low from mid-March, and that was a level we talked about as a downside objective. We kind of gave an if-then statement back here. If we break 58.50, you see downside of the 61.8% level. It worked pretty well here. We bounced into the last week in March to the 200-day moving average. We've now rotated back to test support. We're in limbo, right? We're sort of in a neutral posturing. Again, kind of a classic technical pattern going into big announcement like this. We're below resistance around 5750 to 5800. That's the 200-day moving average. That's now the swing high from late March. We have 5,500 on the downside. That's now a double bottom from mid-March and late March. Whichever way that breaks, I think that's probably the next big duration. My concern and what I see as the likely path is 5,500 doesn't hold, and this is the beginning of the next move lower. We'll see. And again, comments that I've heard, from the administration and others talking about, we don't look at the stock market, don't care if prices go up kind of things. Seems to me that everyone seems to be all right with prices going down as a short-term cost of the proposed or the anticipated long-term gain. Again, we can debate the long-term implications of some of these changes, but I think if the market rallies from here, it's because of something I'm not seeing. I'm defensive right now, and I've not heard anything in the last 24 hours that tells me to be anything but. I'm pretty happy being in gold and cash-like items and a little bit of stocks in very conservative, low volatility areas. That's sort of where I'm hiding out, and I'm not changing that anytime. Not changing that tomorrow, I don't think. All right, looking at the breadth conditions here, we've talked about breadth, and again, I think to be clear, when we talk about breadth conditions, you have to remember these are equal weighted measures. They tell you about the conditions, of a whole basket of stocks, summarizing them and measuring them on an equal weighted basis, which means Amazon has the same weight as like Southern, a utility company, and the same weight as a regional bank, and the same weight as a U.S. healthcare company, right? They all have the same weight because they are equal weighted. Our benchmarks, the S&P and the NASDAQ, are very much overweight the mega cap growth stock. So I think the most important charts to watch here are the Amazon, Alphabet, Microsoft types of names, because Nvidia, because these are the names that move the markets, right? They are really the market in terms of the concentration that we have. Breadth conditions basically tell you, are there opportunities I can find elsewhere? And the good news is I've been able to find things. And I mentioned the special we did on Stock Charts TV earlier this week. Grayson Rose and I shared our top 10 charts to watch for April 2025. We had a big asterisk saying we don't know what's happening with tariffs. This is a bunch of assumptions we're going to make, but that's what you have to do. And we'll see how those names perform, in the days and weeks to come. But one of the things that I think was very compelling was the fact that there were names out there. It just wasn't in technology. I don't think we had a single technology name. We might have had one. But it was a lot of consumer staples, other consumer names, financials were in there a couple times, bunch of other things, right? Utilities made an appearance, sort of defensive, more value-oriented areas of the market, because those are the charts that are the most compelling here. And again, as much as I think we debate what kinds of companies should work, what kind of companies are going to thrive, I would argue the charts are going to tell you which ones are reflecting investor optimism, because the price will improve and the relative strength will improve. All right, that was a soapbox of sorts For the virtues of technical analysis, I'm sure most of you probably agree, or you wouldn't be watching the show. So let's look at this breadth indicator in particular. Worth noting that into today's close, we almost got to exactly 50% of stocks above or below their 200-day moving average within the S&P 500. That is sort of my general assessment. If it's above 50%, that's pretty bullish. If we're below 50%, that's not bullish. We've been below 50% since the first week in March. Today, kind of moving up to there. I would not be surprised tomorrow if this probably rotates lower a bit, but for now, kind of right at that neutral setting. Most stocks below their 50-day moving average, and I'm not seeing a change on that in any case yet. And it's worth noting that with this indicator and this kind of configuration, after a big run higher and you've had a big sell-off, for most stocks, the 50-day is still above the 200-day moving average. Not all of them, but for a lot of them. So most likely you would see this break above 50% first. Like the S&P is still well below its 50-day moving average all the way up there because we had a long-term uptrend and a big sudden sell-off. So it's a little counterintuitive, but we haven't sold off enough for that to change yet. So you'd probably see if we do get a bounce, this would go above 50% first. That's why I'm focusing there, not paying as much attention to this, because for most stocks, they'll hit their 200-day and then would hit their 50-day a little bit later. All right, looking at the advanced decline data, what's striking as I was reviewing the market misbehavior live chart list. This is the main chart list that I keep track of on stock charts. A lot of the macro charts that I include in this part of the show, I kind of bring in from that chart list because I review that list every day. I often review it multiple times a day just to see on how things have evolved, midday, maybe going into the close. And interesting ones I save to show on the program. And I would just note that the advanced decline line on the S&P 500 is remarkably close to making a new all-time high, which is a bit of a head scratcher given the fact that we've had the deterioration that we've had and that the S&P and the NASDAQ are down 10-ish% off of their all-time highs from February. But the advanced decline line really didn't trade down as much, right? Because a lot of S&P names, the movement in the large cap space has been much better than in mid caps and small caps, right? I mean, the general trends in 2025 still favoring large caps. So we're seeing the breadth data quite strong. This is the only one that's above its 50-day moving average. The rest of these all below a downward sloping 50-day. So the breadth in large cap is much stronger than the breadth in other areas of the market. We'll see how that changes, and I think that could be an important theme to evolve, to be honest with you. For now, the breadth still favoring large over small. Looking at volatility, and again, I'm expecting the VIX to be a little higher to quite higher tomorrow would be my guess. But the VIX for now kind of chopping around here. This is very much wait and see mode, right? The major averages kind of drifting higher. Volatility has remained kind of stable. And if you look at the range over the last 6 months here, we're kind of literally at the midpoint, kind of 2150 between 29 and 13. I mean, we're kind of literally right in the middle range of that extreme. So where volatility goes from here probably confirms the next leg in the markets. I would expect higher volatility after what we learned today after the close. Interest rates, another area of the market to watch, right? When you think about the potential impact of tariffs, you can measure that with the dollar, particularly what that means, especially like foreign investors going into the US dollar denominated assets. That's where you can see a lot of those flows. Worth noting, the dollar really hasn't been rallying recently. You can see that in interest rates, certainly in terms of what that does to consumer spending patterns and just the state of the consumer, how expensive it is to borrow money. The 10-year yield has been trending lower as bond prices have been rallying. We'll see if there's a change to that. I mean, I think when you look at the chart of the 10-year yield, it almost looks like a bear flag pattern. You have a downtrend. You have this counter trend channel of higher lows and higher highs and higher lows, kind of counter trend move. And then we've now broken below the lower one. We just got below the 200-day moving average yesterday. Today, kind of pushing back up towards, so not much of a follow through here. So it's almost a neutral kind of wait and see chart. I'm also noting how 4.1%, pretty much where we bottomed out in December and early March. So here in early April, kind of right at that point again. I think if and when rates would break above like 4.4%, kind of breaking above that trend line, that's where things can start to get a little more interesting. I wouldn't be surprised if We'll see what happens with bonds tomorrow. I'm actually not quite sure how things are going to play out tomorrow, but the chart of the TLT are two that I would definitely watch. Worth noting, by the way, the yield curve is back to an inverted shape. If you compare the 10-year yield to the 3-month yield, if you compare the 2s and 10s, it's still actually a slightly normal shape. But to be honest with you, this is more flat than anything. So the yield curve had gotten to a very clear normal shape at the beginning of this year. That's kind of drifted away. Now, what does that mean when the yield curve becomes inverted? That basically is, a speculation of less economic growth, of economic challenges, because the shape of the yield curve is basically pricing in future expectations about economic strength and economic growth. The inverted yield curve was something we dealt with for quite some time, implying a less optimistic outlook for economic conditions. Things were looking pretty good going into the beginning of the year, changing aggressively here in the last couple of weeks. All right, let's look at some individual names. Meta holding its 200-day moving average. One of the things we talked about last week, and I remember sharing this in the weekly flight plan for my premium members, we talked about Meta. I mean, right, whether names like this hold their 200-day, I think that's going to be the basic litmus test for this week. Up until today's close, Meta holding it, right? Up about 1/3%, down about 1/3%. That is going to the close. I was looking at the candle or the bar here, seeing how we closed above the open. So the last couple of days, we've had lower opens, but higher closes. So you're seeing some short-term buying, almost investors buying in on a trade below the 200-day moving average. That's encouraging until it isn't. I think the problem there is when the 200-day breaks in that scenario, that's when things can get ugly very quick. Once investors realize that's not holding anymore, that's when you can really see an aggressive drop. Amazon testing the 200-day moving average from below. The question is, does it get above 200? And if so, we need to clear the previous swing high from the end of March around 206. That's about 10 points above today's close. Again, for Amazon, it's whether we regain the 200-day. Tesla as well, trading, lower open today, higher close, kind of an optimistic, trend to the day going into the aftermarket, up about 5 1/3%. Let's take a shot at Tesla here and just see what's happening after the market. I do see some of you guys trading comments about what's happening. Yeah, so Tesla down about 5% after hours. So we're currently trading around 268. That's not end of the world. I mean, that's kind of, yesterday's high kind of level. That's not horrible. Maybe a little lower. It's down around here. So that, not end of the world. It's kind of the middle of today's range. That's not like we're down at 180 kind of bad news, but it's certainly giving back about half of today's gains just in the after hours. So we'll see what happens. Someone mentioned Meta at 560. Thanks for that. I'm going to assume that what you're saying is true, which would mean we're right around here. So, below the 200-day moving average, but, right at what is that? Monday's range. So these are not horrible breakdowns just yet, but it's basically just giving back. This bounce this week is sort of like some tariff optimism, I guess. And now we're kind of giving back some of those gains. We'll see what happens tomorrow, of course, but that's what's happening in the aftermarket. Netflix looking more and more like just a classic coil pattern. I didn't draw that on here, but I meant to. Coil pattern, right, is where you have lower highs and higher lows. So it's sort of not an uptrend, not a downtrend, but a sideways trend. The market's telling you Netflix is worth around $950. And over the last 2 months, we've basically been rotating around that equilibrium. It's almost like a diamond top of sorts. It's not a perfect one, so I'm not going to draw it, but you can almost see that kind of pattern. But generally speaking, the way that you play this kind of price pattern, ignoring everything else, but just looking at the pattern, is one of these things is going to break. By definition, these lines are going to cross what's called the apex of the pattern. So usually about 2/3 to 3/4 of the way through, I remember John Murphy teaching me you would break above the upper boundary or break below the lower boundary. And again, that means we're not far above that trend line going into tomorrow's session. A break there really suggests further deterioration for Netflix. And Netflix has been, arguably the best of the patterns here, the best of the charts in the Magnificent Seven stocks. Most of these have rotated down pretty aggressively, most below their 200-day moving average. Meta testing it. Netflix kind of the only one still holding above its around its 50-day moving average, which is where we've been rotating. I think a break below like 900 kind of signals further deterioration. After market, we're trading around 911. It's down about 2.5%. We're kind of right at the trend line in the after hours session. I try not to refer too much to the after hours, to be honest with you. It's a little less liquid. It's actually a lot less liquid. A lot of participants like myself are never going to trade after hours. I don't plan to do that. Barring some huge structural change in how equities are trading, it's just not worth it. I'm happy not trading the markets this time of day and just reflecting on what happened. Most institutions would not touch that. So it's sort of the wild west of uncertainty. Tomorrow's open at 9:30 Eastern is when you really start to get most participants reacting to what we learned after hours today. The futures market, very much a great place to look, though, I would say between now and then, certainly before the U.S. Open. I don't pay as much attention to pre-market trading in stocks. I definitely look at futures action because that's a fairly liquid market, the Globex futures before the U.S. Equity Open. All right, to finish off here, I want to highlight again my interview with Mish Schneider, latest episode of the Market Misbehavior podcast. It was a lot of fun. I've interviewed Mish a number of times over the last, probably going back 5-6 years now since I first met Mish at a money show in Las Vegas, and a really fun conversation. Great to kind of get her sense of things. We looked at a bunch of monthly charts of things which I was not expecting, and it was awesome. Just thinking about all the noise and how that just potentially changes longer term structures inspired me to look at the chart of Oracle. I mean, with Oracle, up this week about 3.5% through today's close, but the general trend, the primary trend has been lower. And for me, I always like to say, when in doubt, zoom out. Look at some longer term trend. Look at the weekly chart. For me, the weekly chart, using the PPO indicator, still bearish. We've seen historical corrective periods of a similar distance, some lasting a lot further, but waiting for a PPO buy signal has often been a really good indication that whatever negativity was happening going into that period, we're probably in a bit of an all clear. It gave a bit of an early signal in July. We ended up making a new low, but had I bought in July of 2022, probably would have been happier, 12 months, 6 months, 12 months down the road. So that's the friendly reminder that when things get ugly and I think a lot of people try to focus on, pinpointing the bottom as if that's the most important thing to do. I don't think so. I'm much happier avoiding. I mean, nothing feels better than being in very defensive positions and watching the market go lower because I'm not feeling that pain much at all. I'm in a position that allows me to navigate that and weather that storm just fine. I'm outperforming because I'm in things that are not going down that much. So lower beta, income generating areas of the market, hard assets are the kind of things that I personally own here. And then you wait, and then buy signals from indicators like this, they'll be late, right? You're not going to pinpoint the bottom, but it'll allow you to avoid what probably could be a very painful period. So with charts like Oracle that have broken down, that I think are in clear downtrends on the daily chart, I'm looking at the weekly chart and waiting for those rotations higher. Speaking of rotations higher, I'm looking at the financial sector. Financial stocks were looking really compelling. The XLF still outperforming year to date, but charts like Blackstone not looking particularly strong. But I'm seeing some potential bottoming patterns here. We'll see what happens again related to tariffs. I mean, standard thing to think about with all these charts. But, going into today's close, I'm seeing BX break above trendline resistance. I'll come back to the trend lines in a minute. Bullish momentum divergence with lower lows in price, higher lows in momentum. That's a good thing to see when you've had a thing going lower. You look for improving momentum as a sign that maybe we're going to rotate higher. For this, I probably patiently wait for a break above the 200-day, and that would also get us above that March swing high. So I think Blackstone above, what is that, 155 would be what I would be looking for. I'm jotting this down so I set an alert after the show. But that this pattern puts it on a watch list for me. And then I would probably take action if we would break above that level. If you're more aggressive, taking a position now and then completing the position, right? Taking a partial position as a speculative trade, setting a stop at these lows around 133, 135, and then just betting on that recovery to maybe happen. I don't disagree with that. It's not the way I tend to trade. I tend to be a little more cautious and a little more conservative, but I get the argument. But I would say looking for that validation of a break above 155. At that point, this looks like a pretty good recovery chart. Now, the trend lines I drew, just to briefly point out, and then I'll take a question or two. This is actually a phenomenon or a technique called accelerated trend lines. What happens is when you draw an initial trend line, and the opposite happens in a downtrend. I can actually show it over here. when you have a downtrend, right, and you connect these first 2 points, that looks like a great trend line, but all of a sudden the price action gets really far away from that trend line. So all of a sudden the trend line isn't as helpful because you'd have to go all the way up here just to register a buy signal. So if the slope changes, you draw a new trend line using the second point and then a new third point, and that's kind of your new trend line. And the idea with accelerated trend lines is you draw another one as we continue to go. You rarely, and I don't think you ever really want to draw more than a third one. So we've drawn 2 here. If you have to draw a third one, I wouldn't draw another because that means the slope is getting so significant. You're probably in some other environment you want to be cautious of. But the second trend line, you're looking for a break there. So instead of waiting for the break above this trend line all the way up here, I'm actually looking at a more shallow or a steeper trend line representing the new trend that's been defined. And that gives me an opportunity. And then as a swing trader, then maybe I look at that other trend line as an upside objective to a short-term swing trade. The same thing can happen, by the way, from a low, and the way that looks is this. So I'll draw them with, I don't know if this color is going to even look good at all, but let's try it. So here, I can't even kind of see that. Sorry. Hold on. We'll do like blue, something really easy. Okay, we'll do that. I'll make it really thick. So here we have the low in June of last year, July, pretty good. But all of a sudden we're breaking away there. So maybe I draw a second trend line using these new, lows, and all of a sudden that lines up with a couple of them. But all of a sudden here, we're getting far away. So we continue to draw. And the idea is you continue to draw increasing slopes. You don't go past that third one. So that's it. But then when we finally break that one, that's usually when the top is in, because what's happening is you have an accelerated trend, right? And an exponential rising market. And so when you have that sort of increasing slope on a log scale chart, really the pace of the advances is increasing. And so at some point, you just want to lock in that high slope trend line and just wait for the break. And that's what often tells you that bull trend is over. So I'm almost seeing the opposite of that here, but maybe breaking above it today. Again, we'll see what happens tomorrow. All bets might be off when we do what happens tomorrow. But that's sort of what I'm seeing on the chart of Blackstone. That's probably too many lines to draw on a chart, but if you follow what I was saying, hopefully that helped here a little bit. All right, let's look at some questions. Let's see. Titus Ryder, thanks as always for watching, my friend. You said, hi, David, do you think when everyone digests this load tomorrow, Tesla will be at 225? I mean, that's a great question. Maybe. I think so. So with a lot of these stocks that have had rallies, I think the good news, if there is good news to be had, I would say from a technical perspective, we have a pretty good framework, right? I think the chart of Tesla is pretty straightforward right about now. I mean, the company and the expectations, probably not straightforward, but I would say from a technical perspective, we've had a big sell-off from the December peak to a March low around 220. That is a big drop from 480 to 220, by the way. It does not look like much on the chart, but friendly reminder, whatever platform you use, don't be afraid to use like a percentage tool. You can see on the left side, it's about a 56% drop just from January to March. So these are big. A lot of times charts, the way the convention is to, compress the data or stretch the data to fit the visual space, but it doesn't often tell you the ranges that you're dealing with. With a lot of these names, it's really helpful to really look at the percent swings so you understand this is a very volatile series. It looks kind of normal because most charts kind of look like this, but this is a very volatile data series versus like Blackstone that we just looked at, not even close. So keep that in mind. But having said that, we've now bounced from 220 up to 290. We have the 200-day moving average as a clear level of resistance. We stalled out there about a week ago. We're trading back up to it today. We have the low from early March. So the way that I think of this is if you don't have a position here, I think you wait. And if we break above the 200-day, I wouldn't be opposed to taking a position betting on a momentum swing higher. But 220 is kind of that downside level. And I think breaking below 220 unlocks the door to much further deterioration. You immediately have to look left on the chart and find the 24 lows. That's down to around 140. That's another $80 drop off of the March low. That's a big way down. So your question, 225, that's basically saying, do we get down to the lower end? I would not be surprised if we do get down there, if you get a bit of a bounce, because that's where that strategy I just mentioned to you, I'm not the only one kind of picking up on that clear structure. And so I think you would bet on some sort of bounce coming in that 220, 225 range for sure. But I would say a break below there, that's one of those like lookout below kind of charts when I'm very happy finding something else to do with my capital because it's not great. Let's see. A lot of speculation. I'm looking for something that's more not about the tariff because I totally agree with all of you saying a lot of questions about that. Let's see. Oh yeah, the gold silver ratio. That yeah, great question. Hold on, let me bring this up. I saw that before I was looking here. Yeah, 3P investors. Thanks for watching. You said a question based on your interview with Ms. Schneider. Can you give your opinion on gold to silver ratio from your experience dealing with many traders and big institutions? Yeah. So again, I'd encourage you to listen to that interview. That was a really interesting point. Again, what I loved about that question was if you will hear if you've heard me interview people, and I really enjoy interviewing people. Hopefully, I'm able to get good insights from the guests, which is my goal. Just have an interesting conversation and get some good insights that I think will help us all just understand a little bit more about their thinking and their approach and their opinion. But it was interesting to me. I've often found when I ask a question and someone asks answers a different question or says, yeah, that's interesting, but and kind of diverts, that really tells you a lot about where their head is out and what area of the market they're really deeply focused on. I thought it was really interesting. Mish, a number of times over the years, I've asked her about gold because that's what I watch gold all the time. I watch it every day. I invest in gold. I don't invest in silver that much. And so I'm usually paying attention to gold prices. So I ask about gold. I think about precious metals. I say gold and GLD or something. She immediately went to silver. And I remember talking with Mish years ago about silver is a better one to look at. And I'm not going to paraphrase too much, but basically because it was a better reflection of sentiment. The gold has just a lot of participants, a lot of things going on. Silver was more of a better pure look at precious metals and what the opportunities might be. The silver to gold ratio, I haven't had a chance to unpack what she was talking about. She basically was saying that the silver to gold ratio is a good one. I'll work up some long-term charts about that and dig into that a little deeper. And your question on do institutions pay a lot of attention to that? I mean, not really. What happens in the investing space, particularly when you get to that, like institutions, you have a lot of brokers and a lot of independent research firms giving you a lot of ideas from a lot of places. You would have firms or analysts that are focused specifically on the commodities market. And that's where I could see something like that coming up, looking at ratios of different commodities and thinking about the message there. It's really helpful. And that's one of the benefits you have as an institutional investor. You have a lot of people, a lot of smart people with great experience, and you can call them and ask them any question at any hour of the day, as sad as that is for them, I think, in their lifestyle, their life balance. But, you call them anytime you want and get deep thoughts on ratios like that. So it reminded me of some of those great conversations I had with commodities analysts really focused on that kind of relationship. So that was a long-winded way of saying not a lot of people pay attention to that ratio. I'm certainly going to be looking at it. All right, last question. That was not the one, Joe. I appreciate you watching. You said, have you discussed the S&P 500 downside objective, assuming it breaks down tomorrow? I don't think I did. So what a great question to end on. And thank you for watching. So here's what I would say, right? I don't, no change to this. I mean, my general discussion starting back here, if you followed my work, has been this market is overextended and probably topping out. And the number of signals that we discussed from November through January and February were pretty striking. And I'm still going back to the Hindenburg omen in December. Ended up being just a brilliant sign that things were going to start to get ugly in the new year. So I've sort of been talking about a downward trajectory in the S&P for a little while. During this counter trend bounce, I've been labeling this a counter trend rally. I stand by that labeling. I would say the bounce we've seen this week is not anything that changes the picture for me. I think the market's guilty until proven innocent. What I learned today doesn't change that. For me, the initial downside objective after 5850 was sort of our initial line in the sand. When that breaks, it's 5,500. If and when that breaks, which I think it will, I'm down to 5,100 to 5,150. That would be 100% retracement down to the August lows in the S&P. That would also be a 38.2% retracement of the broader uptrend of the S&P off those major lows a couple years ago up to the February peak. So a lot of things line up to that being sort of a major level. I wouldn't be surprised if that ends up being sort of the end of a big corrective move that probably takes a little while to get there. But we'll see. For now, 5,500 is the level. As early as tomorrow, I'm thinking that's going to come into play. So make sure you tune in tomorrow. We'll see how things play out, and I'll share as many insights as I can as we all navigate these uncertain, challenging markets together. Folks, that'll do it for today. Thanks for joining me. My name is Dave Keller with Market Misbehavior. Pleasure to have you join me on the show, and I appreciate you doing so. Remember, it's always a good time to own good charts. Have a good night, folks.